Hello, everyone. Welcome to the weekly roundup. Today we will cover inflation, growth, and market sentiments. Hello, Ben.
Hi, Eva.
Nice day out.
The sun shining.
I
Definitely. That's
know.
good. That's good.
And the roads are clear, like there's no single snow.
That's nice. And tomorrow it's gonna be we get 1 day of summer. It's gonna be 20. It's gonna be
Awesome.
20. That'll be
Oh,
nice.
welcome to the good times. So we've got a lot to cover.
Sure.
We're going to start with growth. Canada posted modest growth at the start of the year, but with manufacturing under pressure and resource sector still doing the heavy lifting, is the economy showing resilience or is it masking a deeper weakness?
I think that's a great place to start and a great question. Our chief economist this week, Stefan Marion, put out a piece kind of commenting on that because there's been so much talk and thought around there's some risk with, inflation's going to run away. We're going to have another 2022 or 2020, depending on how you want to look at inflation. But the point I think is right where the inflation pressure is probably not as strong. Yes, there's some upward pressure with tighter gas prices and supply chain and things like that. But the economy was and is deteriorating already. So I think that, we're more likely in this environment where, growth continues to slow. To your point, oil and energy is probably masking the number, and unemployment's rising pretty quickly. So I think, all that points to the fact, yes, there's some pressure, but the rest of the economy is probably in worse shape than the energy space is right now.
Okay, so we're just gonna look a little further in the future.
Hmm.
Even if geopolitical tensions cool, has this oil shock done enough damage to keep inflation elevated and slow growth, looking forward in the next 2, 3 quarters?
Yeah, so I think it's a great point. I think it's something very important to watch at this juncture, particularly for Canada. Um, our economy probably is feeling better than the others, and we'd already been slowing. And so there was kind of a knee-jerk reaction to interest rates because there was this fear that inflation is going to be sustained. And so you had the expectation that Bank of Canada is going to raise rates a couple times this year, because of that kind of knee-jerk reaction to higher prices. So will inflation stay elevated? I mean, I think the answer is maybe. But at the present point, if this conflict starts to resolve itself sometime in the next, we'll say 30 to 60 days, then I don't think it's sustained, because our economies are already deteriorating. So, I think it would be, I think it's temporary, but the environment we're in today with the Iran conflict is, I mean, an hour by hour, day by day kind of event happening right now.
Yeah. Drilling down to the markets, we had a difficult first quarter. Are investors, correctly pricing a path to peace in the
Mhm.
Middle East, or is the rebound short-lived? And if this volatility persists, where should investors look for opportunity?
All great questions, and and I think there's a multitude of answers. And so I think to some extent we've had March really was a period of elevated volatility, and that is something we haven't seen in a number of years, where we saw volatility elevated. We also saw, as you know, I like the sentiment gauge, so we saw market sentiment heading down and down and down as we got into I think the Monday print was 16 on a scale of 100. So 16 with is really showing extreme pessimism. And I think we saw some capitulation last week, Thursday, Friday. Then we had a recovery to your point earlier. And now we've had, I guess, a little bit of chop as we head into Easter weekend here. So I don't know if you follow some of the things that Trump says and does, but from a with respect to Iran, he said yesterday that he had a discussion with a peace or with a negotiator within the Iranian government, and Iran came back and said that that person doesn't exist. They don't even know who he's talking about. And so, there's so much that he says that has an impact on markets. He was in, President Trump spoke to someone within Nintendo. I don't know if you saw this, but and he talked about the founder of Nintendo, that he had a conversation with a guy the week before, but the guy's been dead for 5 years. So a lot of the things that he says has an impact on markets. And so that's caused a significant amount of volatility, and I think that'll continue to be the case. Like I came in today, and TSX was negative a couple hundred points, and now we're positive 100 points. But long-winded answer to your question is where are the opportunities? I think that there was significant pressure on a lot of the tech companies ahead of this. And so you get some of the better businesses, and yeah, I'd look at a company like Adobe, which really focuses on cyber, and the stock is down 25% prior to this and probably down another 15% since then. And so that's, I believe, presenting some opportunities there. And some of the other, if you like Meta, for example, they've come under some negative pressure and press. And so their stock's trading at maybe 20 times earnings, which is as attractive as it's been in a long time. So I'd say those would presently be where the opportunities are. I mean, people are asking, what should we do with energy? Should we buy energy, sell energy? If you were fortunate enough that you own some ahead of this, then probably sit tight and see how things play out because energy stocks are up a lot. And maybe look for an exit opportunity if we see a blow off top to the upside. But I'd be looking at other sectors that are beat up. And last one I'll comment on is maybe bigger picture. Like a couple of the countries that I spoke about in our annual outlook was India and China. So those two, yeah, economies, I think, are more of the two most negatively impacted for the other side of this trade, which is if energy prices resolve lower, those two countries probably accelerate significantly higher. So those are areas where I think you could chip away at, and if you look 2, 3 years out, those would be great opportunities to enter.
Absolutely. Yeah, let's see the charts.
All right, so we are, amazingly enough, April 2nd. We are recording this around 1 o'clock, April 2nd. So anything that happens between now and April 9th, we'll comment on next week. And so let's just jump into it here. Let's start off with this one. This is a great chart from ISI Evercore, which is one of our partners. This is the Bloomberg Financial Conditions Index. So I look at a lot of things, we talk about a lot of things, but financial conditions are one of the things that either makes me very happy or very sad and plays a part in what I think about where the potential opportunities are. And so, if you look at the financial conditions index, this is bad. So these are kind of near-term lows. And so this would be higher interest rates, tighter lending practices, we've seen private credit come under pressure in the US. So the kind of knock-on effect of these is private credit comes under pressure, which flows through to the banks that lend to those people. And so that would tighten up their lending practices, would have an impact here. And certainly interest rates and long duration assets, interest rates have gone up on the long end, at least from a perspective of where we are versus where we were. So like mortgage rates in the US had bumped up to about 8%, which is quite punitive. And so financial conditions is a very important metric. So you can look at this two ways and say, okay, this is bad and going to get worse, or you can say maybe we're starting to bottom And so this was a pretty material, steep decline. I think a knee-jerk reaction to higher interest rates and deterioration in the global economy and US dollar pressure and so on and so forth. So, this will be an important metric to say, um, maybe we start to move higher, maybe we grind around sideways, or maybe we dip a bit lower. But this would be something I'd pay a lot of attention to. If you are looking and thinking about the markets from a valuation perspective, you may look at this and say maybe it makes sense to put some money to work. But if you don't like to wade into difficult and uncertain markets, then you wait for this to start to turn up. And if this starts to turn up, that's when money supply starts to increase and things get a little bit better. Markets start to move higher on this lever. But this is a key piece that I'd be watching, and I think you should too. So onto the next chart. This is the balance of risks has changed. So this comes from our Chief Investment Office. They put out quite good reports, and I think this is an important way to think about economies and markets. And so this is a Goldilocks, which is kind of best case scenario. This is trend growth, which is we continue to grow steadily and stably. And this is recession with a new addition to stagflation. And so if you look at these metrics up here, so this is March, June, September, December, and then March of this year. And so if you look at March of last year, what do we think with likelihoods? Said 60% trend growth, 30% recession risk, and 10% Goldilocks environment. And so we got effectively trend growth to a little bit below trend growth, but not a recession. And then if we've kind of fast forward to where we are today, which is this March of 2026. So this is this black box here, 10, 60, 30. And so I think one of the things to look at here is, our economics team, certainly to answer your question from the start of the conversation, Eva, was our economics team says very unlikely that we're in the Goldilocks phase. And more probabilities towards trend growth or stagflation. So still leaning towards this trend growth, 60% probabilities. And so try to construct the portfolio with that in mind. But this has jumped out of nowhere, and this is as a result of the Iran conflict. And so stagflation, for those who don't know, is growth decelerating, inflation accelerating. That's not a super nice environment for many asset prices. Really, only commodities tend to do well in that backdrop. So that stagflation's jumped up. This is, I think, a good way to think about probabilities, think about economies. And so I'd be leaning somewhere in the middle of this, trying to be conscious of all of these potential outcomes. If we get a resolution sooner in Iran, then I think this component completely dissipates, and you would see maybe this start to pop up into the 20 to 30% range. Then from your question just about returns and where the potential opportunities are. So on the left-hand side here is the S&P 500. This is month to date, year to date. And then on the right-hand side is the TSX, which is the Toronto Stock Exchange. You got month to date, year to date. And so again, I'd look at a number of these buckets. Obviously, if you're on the Canadian side of things here, you look at energy. Obviously, energy's had a run and material run given what's happening in Iran today. And so when you look at a month-to-date performance, that was really the only asset class that was positive, so up 8%. Materials got smoked, so that'd be probably mostly base metals, precious metals, mining. So they got hit quite hard. So people ask me, well, why is that the case? And I think when you're looking at delevering coming out of the system, money coming out of the system, you're going to look to sell some of your winners because you have a profit in them. So you would have seen a material drawdown in that space because you had delevering happening, people, institutions looking to sell some of their winners, and that's where we got a bit of a reaction there with downside drawdown there. And then, as I mentioned, the other sectors where I said potential opportunities are, if you look down here on the year-to-date or one-year basis, some of the tech companies have been hit pretty hard. I think an overreaction generally, and so that'd be something that you'd want to consider. Maybe there's an opportunity there. So if we look over briefly onto the S&P before we go on to wrap up here, month to date down 7.3%. That's in US dollars, and CAD that's about just under 6%. So US dollar If you owned US assets, that helped you because US dollar went up versus CAD for the month. And then energy was up there as well. Materials didn't get hit as much as on the Canadian side, but everything else pretty much across the board came down, drew down. And then in the technology, communication services, these overlap. There's a number of different companies that are quite similar in here. And so there's been a material drawdown in certain sectors, so that'd be another area that you'd look to consider. As always, the opinions expressed do not necessarily reflect those of National Bank Financial. Everyone has their own risk tolerance. Everyone has their own views and expectations. You got any questions, please reach out to Eva or I, and we're happy to address any of those things that you may have.
Thank you, Ben.
Yep.
So what are we looking at for next week?
Well, I think just like we've been dealing with the last to day to day here, which is U.S. and Canadian and bond markets, everything's closed tomorrow for a Good Friday, and then Monday will probably be lighter trading, but that's contingent on nothing happening between the U.S. and Iran and the rest of the world, we'll say, over the weekend. So that would be a day to day. Watch that, continue to see what happens there. I'm am anxious to see how this continues to float through in the system because volatility has started to come down. And I think we may have talked about it last week or the week before. I'd be watching those, like the MOVE index, which is bond volatility, VIX, which is equity volatility, and gold volatility as well, which is GVX as well. So I'd be watching those numbers and see if they grind down, and that gives you a bit more confidence and clarity that volatility is coming down. And then maybe we see some resolution in equities, but all of the focus in the world is between Iran and really the rest of what's going on in the world. So I'd be watching everything kind of day to day, but likely lighter volumes on Easter Monday.
Okay, sounds great. Thank you, everyone. Remember to visit, subscribe, and follow us on YouTube and LinkedIn at Hart Investment Group. The link to our daily financial newsletters will be in the caption of this video and in your email box. For our clients, please reach out to me if you have any questions or if you'd like to book a review meeting with Ben. Thank you once again and have a great Easter holiday.
Thanks, everybody. Take care.
Bye.